Picture this. You just survived a brutal month flipping burgers at McDonald's. You're lying in bed when your phone buzzes. A pay stub notification! It says you earned $2,000. But your bank account only receives $1,456. You scroll down the stub. Federal income tax, state tax, Social Security, Medicare. Welcome to the modern ritual of handing over a huge chunk of your hard-earned money to invisible forces and being expected to say, thank you. Here's the deal: taxes are the cost of civilization. You pay, and in return, the government builds roads, funds schools, ensures your favorite taco truck isn't infested with rats, and sends billion-dollar missiles to places you've never even heard of. There are a few main types you need to know. Income tax hits the money you make. Sales tax hits the money you spend. Capital gains tax hits the money your investments made while you were asleep. Then you have Social Security and Medicare. Social Security is basically the government forcing you to save for retirement. They take your cash now and pay it back to you when you're old. Medicare, on the other hand, is health insurance tax that supports seniors and people with serious health conditions. Now comes filing your taxes. Oh boy, the government already knows roughly how much you owe, but they make you guess anyway. Get it right? Great. Get it wrong? You're cooked. Some people pay every few months, some pay yearly, and some don't pay at all and wind up starring in a true crime documentary. Look, taxes are annoying, but countries with higher tax rates generally enjoy a much higher quality of life overall. So you walk into a bank, hand over your cash, the teller smiles and confirms it's in your account. You walk out thinking, awesome, my $1,000 is safe in a vault guarded by a dragon. In reality, that money is already gone. Banks aren't big safes, they are matchmakers. When you deposited that $1,000, the bank kept a tiny bit and lent $900 of it to someone buying a jet ski. This is called fractional reserve banking. It works on the assumption that not everyone will show up on the exact same day asking for 100% of their money back. Unless it's 2008, when everyone tried to withdraw their money at once and the entire system crumbled. Banks make money by lending your cash out at high interest rates while giving you peanuts in return. You provide the supply, the borrower provides the demand, and the bank takes the cut. So why keep money in a bank? It's more convenient than dragging around a bag of cash. They pay you a little interest. FDIC insurance. In the US, your deposits are insured up to $250,000. Even if the bank goes under, the government guarantees your money is safe. Imagine you borrow $1,000, but you have to pay back $1,280. Why? Interest. Interest is money's way of charging rent to exist in someone else's hands. When you borrow, interest is the price tag. When you save or invest, interest is your reward for being patient. There are two main types: simple interest, a flat fee. Thanks for playing. Compound interest, every dollar you earn spawns clones, and those clones start charging rent too. If you owe 20% on a credit card and miss a payment, compound interest works against you. Suddenly, a $12 burrito turns into a $50 regret. On the flip side, invest at 7% compound interest, and your money multiplies like a cheat code. $100 becomes $200, then $400, until one day you wake up old, rich, and slightly smug about it. Interest is either your worst enemy or your best unpaid employee. The choice comes down to who's collecting it. You buy a bag of chips, open it, and it looks half empty. Worse, you paid 30% more than last year. You've just been hit by inflation. Inflation is the slow erosion of money's purchasing power. Your $5 bill still says $5, but it buys less gas, fewer noodles, and carries less real value than before. What causes it? High demand. Everyone has extra cash and tries to buy the same thing. If 2,000 people want a $500 TV and supply is low, the seller bumps the price to $800. Supply chain issues making items gets more expensive, so costs are passed to you. Expectations: if people expect prices to rise, they buy now, which drives prices up faster. A self-fulfilling prophecy. A little inflation, around 2% a year, is normal and healthy, but when it spikes, savings melt and wages lag behind. To stop it, central banks raise interest rates. This makes borrowing expensive, cools off spending, and brings prices back under control. A recession happens when the economy shrinks for at least 2 consecutive quarters, or 6 months. One day you're planning a family trip, and the next, layoffs hit the news and stock markets plummet. Companies cut costs, jobs vanish, and everyone stops buying luxuries to hoard cash for survival. Why do recessions happen? High interest rates, global shocks, or simply the economic cycle doing what it does best: boom, peak, bust, reset. Recessions are painful, but they aren't permanent. Governments lower interest rates or send stimulus checks to kickstart spending. Eventually, businesses rebuild, growth returns, and the cycle starts again. Next up, your credit score. It's a shadowy algorithm that tracks your financial history and condenses your trustworthiness into a 3-digit number between 300 and 850. This number isn't about how rich you are, it's about trust. Lenders want to know, if I lend this person money, will they pay me back? Below 580, you're a walking red flag. Above 750, you get the best interest rates on houses and cars. It's calculated using your payment history, credit utilization, length of credit, and account variety. Want to build it up? Pay every bill on time before the due date. Here's the catch: you can have zero debt and $100,000 in cash, but if you have no credit history, your score will be garbage. It's not about being good with money. It's about looking good to lenders. Learn the rules, and you can play the game to your advantage. Here is the weirdest concept of all: money isn't real. A dollar bill, a Bitcoin, and a wooden stick have no intrinsic magic. The only reason you can buy a sandwich with a dollar, and not a stick, is because society collectively agreed that the dollar has value. Governments print currency, and central banks regulate it. If they print too much, inflation explodes, and your savings turn into monopoly money. If they print too little, the economy freezes up. Money is simply a social construct built entirely on trust and belief. Since inflation constantly erodes your cash, how do you protect it? Investing. Investing is when your money stops sitting around and goes to work for you. Instead of trading time for money, you trade money for more money. Main options include stocks, buying tiny ownership slices of companies; bonds, loaning money to governments or corporations for interest; funds, ETFs, index funds, baskets of stocks so you don't have to pick individual winners; real estate, physical property that generates rental income. Investing involves risk. Markets go up and down, but the biggest risk isn't market volatility. It's keeping all your money in cash and letting inflation silently steal your future. Why is gold worth more than a regular rock? Functionally, it's just a piece of the earth. But because it's rare and people desire it, we place a higher value on it. Understanding value is the secret to building wealth. If you provide massive value to society, society pays you massive money. Steve Jobs created the iPhone, providing immense utility to millions. Doctors and lawyers solve high-stakes problems. Luxury brands like Gucci sell $2,000 bags made of basic materials because buyers perceive them as highly valuable. If you can figure out how to create or communicate value, you will never struggle to make money. Finally, the most valuable asset in the world: time. Almost everyone starts with a lot of it, but nobody gets an unlimited supply. Most people trade time directly for money, 1 hour for 1 paycheck. But true wealth is built by leveraging time through investments. Wealth isn't built in days, it's built in decades. A modest paycheck, invested consistently over 30 years, leverages the exponential power of time to turn ordinary people into millionaires. They didn't beat the system. They just let time do the heavy lifting. If you found this breakdown helpful, hit that like button, subscribe for more financial breakdowns, and let me know in the comments which concept surprised you the most. Thanks for watching.